Good afternoon. It's Jeffrey Christian. It's about 1:50 in the afternoon here in New York on Friday, the 14th of April. I want to give a talk about gold and silver prices, which had risen sharply on Tuesday, Wednesday, Thursday. They're off today sharply, and they're running in a way that might be counterindicative to some people who believe in certain relationships between inflation, interest rates, and gold and silver prices. We talked about gold and silver prices and their relationship with interest rates and the dollar and inflation in our last video, and have to talk about it some more. What we've seen this week is we had the CPI come out on Wednesday, and it showed a decline in interest rates or inflation rates across most sectors of the economy. We'll look at it a little bit more. But rates rose 1% in March on a month-to-month basis, and they continued to decline on a year-over-year basis. Energy was up on a year-over-year basis. On Thursday, then, the PPI came out, and it showed a decline, a sharp decline in March, with significant declines across most sectors of goods and services at the manufacturing wholesale level. So you had lower inflation rates, and the result was that gold and silver prices rose sharply. Kind of difficult to reconcile with the firm belief that some people have, which is not statistically supported. Simple mathematics and arithmetic will show you that inflation and gold and silver prices do not, in fact, rise together and fall together all the time. Sometimes they do, sometimes they don't. The correlation historically between gold price changes and inflation is something like -7% over the last couple decades. And it's something like 9% positive over the last 40 or 50 years of free gold prices. But inflation figures showed significant declines in March, both in the consumer price level and producer price levels. You also had weak consumer retail sales reported on Friday. And when that happened, it was interesting because you saw interest rates fall and gold and silver pop higher. A little bit counterintuitive. I think several things were going on. One of the things is that market expectations were that if inflation was in fact coming under control, and it has been for the last 12 plus months, I guess, or since the middle of last year, so that's about 9 months. But if inflation was continuing to come under control, and you're seeing these figures not only in the United States, but also around the world, in Japan, and Singapore and Mexico and in some European countries and in Australia, you're seeing deceleration of inflation rates. And inflation rates are much lower in many of those countries and are getting back down to what they consider to be long-term acceptable rates. But the view, I think, in the market was that if inflation was in fact coming under control, interest rates would not keep rising. Now, the Fed has said repeatedly they thought another 25 basis points in May, maybe another 25 basis points after that, but probably not. But the markets keep saying, no, the Fed's going to have to lower interest rates sooner than the Fed is saying. And the Fed is saying, no, we don't think we're going to have to, but let's see when we get there. And I think it's not that the Fed has been surprised by inflation figures. It's that the market expectations for inflation and for interest rates have been out of line with economic reality, financial market reality, and they're starting to come back down. And it's kind of interesting. I was talking to somebody, and they said, you have these people, there are two groups of people who opine about inflation and interest rates and gold prices. One is the broader financial markets, and they've had a view which has run contrary to the Fed's view and the view of many, but not all, mainstream economists who look at these things. And then you have the other guys who have this more of a belief than a knowledge base. And it's funny because if you think about it, the Bureau of Labor Statistics has something like 350 economists working on consumer price inflation. And what they do is they have volunteers who collect data on what they buy each month and what they pay for it and hand that in. And it's a survey of something like 5,000 citizen households across the country, that all of that data, what they're actually buying, so you have a good idea of how the basket of goods and services that people are paying for change month to month and year to year and over time. But you have 5,000 people submitting data on what they actually spent on goods and services. And then that goes into the Consumer Price Index. And there are 350 economists who sort of stand over it and make sure that everything works. And that's what you've got in the Bureau of Labor Statistics for the Consumer Price Index, similar numbers for the Wholesale Price Index, versus some guy sitting in his office saying, no, inflation has got to be much higher than they say. I'm sure they're skewing the numbers. It doesn't make sense. But then, if you want things to make sense, get out of the financial markets, I guess. So the market expectations have been that interest rates will not keep rising, that they will plateau. You actually have some people saying that we might not even see an interest rate increase in early May. We think you will. And the hopeful believers think that you might see interest rates falling. We disagree. And there are a lot of other factors that are worrying investors and causing them to buy gold and silver, not the least of which is the political impasse over the debt ceiling in Congress and the view that that impasse over the debt ceiling, which is a nonsensical issue, reflects a much bigger stalemated government that's not going to really be able to handle anything in a mature and an intelligent fashion. And that causes investors to say, okay, maybe inflation's not a problem. Maybe it hasn't been a problem for most of the period from 2000 to 2023. There was a period of inflation in 2021 when we came out of the lockdown. It peaked in the middle of last year and it's been coming down since. But if you look at the period 2000 to 2021, inflation wasn't the problem and it was declining. And gold prices went from $250 to $2,000. So clearly it wasn't inflation that was causing investors to say, I am worried, let me buy gold and silver and have more of my wealth stored in gold and silver. Silver went from $5 to $50 and back to $12, and back to $25. So that's sort of what's been going on. Let's look at some of the numbers on inflation. These are the month-to-month changes. You can see 0.1% increase in prices in March relative to February. That was among the lowest levels really since last July, which was the peak of the period of higher inflation. Not hyperinflation, but higher inflation, a 1.2% increase month over month last July, and a 0.1% increase in March of this year. And then if you look at it on a year-over-year basis, you can see, and here it's cute because the blue line, which is headline inflation, which includes the more volatile food and energy, actually was decelerating more sharply than the core inflation, which excludes food and energy, last month. Core inflation actually rose a little bit. You saw stronger prices. New cars were up like 6%. But the big increases were in services. Transportation services continue to be a problem, and healthcare services and restaurant services continue to be seeing higher inflation than the other parts of the economy. Non-food and energy goods actually were pretty much under control, as were a lot of food prices. And you actually saw some food prices decline. Energy prices fell sharply, which is why you have the headline inflation actually decelerating more than the core inflation that excludes it. So you are seeing a continuation of the deceleration of inflation. If you look at where we saw it, all items, the blue was food actually rising, energy fell sharply, and all items ex food and energy rose at a pretty high pace. And that again reflected services for food, restaurants, and transportation. I showed this chart earlier. We had updated it. I used the chart that went through the fourth quarter of 2022. It's April now. We have the first quarter of 2023. Gold prices rose sharply over the last month, while inflation was decelerating sharply over the same period of time. Again, simple mathematics, even just basic arithmetic, can show you that there isn't a one-for-one correlation between gold prices and silver prices on the one hand and inflation. But if you never studied math in grade school, you wouldn't know that. We have our gold yearbook out. You may purchase it online at our website. It's an ebook. It gets downloaded. You can download it as soon as you bought it. The last page tells you how you can take it as a PDF to a copy shop and have it printed and bound, what the specs are for the books as we are. The silver yearbook, we will be launching on May 16th. The platinum yearbook in the middle of July. You can pre-order those books at our website. Go to our website and read other things that we've produced, see other videos, read about who we are, what we do, and look into our retail investment program and other programs that might be of use to you as you seek to be more efficient in the way you manage your exposure to commodity prices. That's all I have for now. Have a good weekend. Take care of yourself and those around you, and try to do something good for the world. Because if more than half the people try to do something good for the world, maybe we'll have a better world. Take care.